Okay, how's everybody? Hi, good afternoon.
Good afternoon, Professor.
Good afternoon, DeAndre. Good afternoon. Good afternoon, Sora. Hi. So today's the last day, and never thought, uh, well, to begin with, I never thought we would have enough time to cover everything, but we are always, it's a tight, very tight schedule. Summer 2 is always, on a very tight schedule. So I don't think it is really, realistic that we can cover. I mean, it's almost a logistical nightmare. Summer 2 is really logistical nightmare. So I'll have to give it a best shot, no matter what. Okay, so looks like I have 9 people here in the collaborate, and so one more person here in the collaborate. So whoever hasn't signed into today's forum, please don't forget to sign in there, because that's the only way to establish your attendance. Now, so the last thing we were talking about was, stock value. We were just about to, excuse me, we're just about to go into stock valuation model. That's risk and return. Where is this? Okay, this is the slide. And what do I have here? No, wait, it's not opening. All right. Okay, it's taking too much time again. Okay, so there are, we talked about this last time. There are 4 different stock valuation models, and they are all called dividend discount models. So basically, it's all discounted cash flow models. So we don't have time to. I don't think we have time to do actually, free cash flow model. But so think about it. First, so of the 4 stock valuation models, the first one and the second one, they may be confusing because the name both says constant something. But number 1 is constant dividend model, which means 0 growth, right? If the dividend is constant, that means the company is because the company's profit is not growing, right? I told you, in principle, theoretically, dividend depends on the net profit, and if the profit goes up, it's supposed to go up. Profit goes down, it's supposed to go down. But it has nothing to do with the growth. it's just always constant. So you remember preferred stock. Preferred stock pays constant dividend. My handwriting is horrible, I know. So preferred stock would be valued this way. And the preferred stock, another name for preferred stock is perpetuity. And what does that mean? Literally, it's a perpetual annuity, right? It pays constant dividend, so it's an annuity, but it doesn't have any maturity. It goes on forever, hence called perpetuity. So constant dividend model is also called zero growth model, and it's also called perpetuity model. And the formula is dividend over R. If we had more time, I would like to explain how this formula has been derived, how they arrived at this, but we don't have time for that. So I'm not gonna. But basically, everything is, think about it. We have dividend is constant, so there is no need for any time subscript because dividend at time t will be the same thing as dividend at time t plus 1, t plus 2, t plus 3. So we don't need time subscript, right? So the same dividend. And then it must be discounted once. The second dividend will have to be discounted twice, and so on. And this, because a stock is a perpetuity, this will go on forever, right? Let's say, and then I told you dividend in the infinite future, then discounted by infinity, 1 raised to r, and the value of that stock in infinite future when discounted by 1 plus r raised to infinity, right? They will all fall, they will all drop out because they are close to 0, right? And then how does that reduce to this? That part, we don't have time for that, but believe you me, this thing, this long polynomial is, collapsing to eventually all, reducing or collapsing to that. That's the constant dividend model or zero growth model. And the second, constant growth model. Which is also called golden growth model. Now, constant growth means dividend. Dividend is growing at a constant rate. Okay, so then this is the opposite of constant dividend model, because constant dividend model means dividend is growing at 0 rate. So that's why it's called zero growth. It's not growing, but this is growing at a constant rate, positive constant rate. So it's quite the opposite of zero growth model. And in that case, value of the stock is dividend at time t plus 1 over r minus g. Okay, and then of course r is the required return, the discount rate, but in case of stock, the discount rate is called required return. Okay, required return. There's a required return for each stock, and it doesn't depend on the credit rating. It has nothing to do with. It will. You cannot say it's completely unrelated to credit rating, but it is related to, because the lower the credit rating, the greater the risk. And if the risk is greater, then the required return is greater. And G is the growth rate. And if you know constant growth rate. How do we find constant growth rate? We know already. We know geometric average, right? Find the constant growth rate by geometric average. Because in reality, think about it, nothing grows at a constant rate. But, why do we then, why do we find, geometric average? Why do we find average? Well, even though it is not actual growth rate is not constant, if we find the average of all those uneven growth rates, that can replace all of these different rates, and just we can simply this 1 plus g raised to n, right? That will take you to the same future value. I showed you this before. So the reason for using average here is is quite justified. I mean so in other words, reality is not that the growth is, in reality there's no such thing as constant growth rate, but the average, right? We can find the average and use it as if the growth rate is constant. And then dividend at time t plus 1, that's the next period dividend. How do we know that? How do we know that? We don't know what, we don't know the future. Whatever is in the future, we don't know, but we can make a forecast. So dividend at time t plus 1, the forecast of that is based on today's dividend at time t, and then since we know the growth rate of the dividend, we multiply it by 1 plus g, right? Then we can forecast next period dividend, and so we get to this. So this is the golden growth model, or constant growth model. And then third, variable growth model. This is more realistic because in reality, not every company grows at a constant rate, right? Some companies go through different growth phases. So variable growth model, but still, it is assuming two growth periods, very fast growth period, and relatively steady. So that doesn't look like. Very, rapid growth rate, and then relatively steady and slow growth rate. So as long as we can identify two growth phases, right, we have to use, variable growth model. And of course, when the growth is relatively steady, we use Gordon model, right? Gordon growth model. And this part, we'll have to find it separately. I mean, we'll have to find the present value of all those future cash flows separately. And then fourth model is free cash flow model, free cash flow. And free cash flow is a very important concept, but the free cash flow model is used when the companies don't pay any dividends. Now think about it. All DDM, they break down, right? If DDM breaks down, if the companies don't pay out any dividend, we can use DDM, we can apply DDM only to the cases where they pay out dividend, right? Now, if they don't pay out dividends, then we cannot use this. Then what do? We'll have to use, if there is no DDM, if there is no dividend, we'll have to use free cash flow model. Okay, all right. So without much ado, let's take a look at some examples. Okay, let's do some examples. How do I get rid of this? Okay. So here's one example. Chuck Swimmer estimates that the dividend of Denham Company, an established textile producer, is expected to remain constant at $3 per share indefinitely. Now, these words, I mean, you think this is just verbiage. Yes, it's verbiage. I mean, you have to, but you have to, like, you should be able to filter out, right, all the unnecessary verbiage and only, uh, only, find, only, bring it down to only to the nits and grits, only to the nits and grits, So in this example, what matters is dividend paid. Dividend is $3 and it's going to remain constant. That means this is going to be a zero growth model, right? Denham Company, it doesn't matter. The name of the company doesn't matter. Chuck Swimmer, to hell with those names. You can call it Mr. X, Mr. C, Denham Company, Company D, right? Next, textile producer, doesn't matter. I mean, the industry, does the industry matter at this point? No, industry doesn't matter at this point. I mean, if you want to do the industry analysis, in other words, fundamental analysis, and you want to do what is the liquidity ratio, what is the current ratio, what is the return on assets. If you want to do that, then what industry it belongs to, it matters because you need to look up what is the industry average, and you need to compare your ratios with that. But for valuation purpose, that's unnecessary. What industry it is in doesn't. But established. You might think that's just another, just another part of the verbiage. But actually, it is not hollow verbiage, right? It is an important clue, right? Why? Oops. You see, when you read, something like novels, or essays, about 80% of all the words is all frills, right? All just fat, all nothing nothing crucial. It can be all whittled out. All the unnecessary unnecessary frills can be chopped out, and it can be distilled into a few few critical points. What, in other words, every sentence can be just what should I say, simplified, or every sentence can be lean, made lean. Every sentence can be made lean and reduced to subject, verb, and object, or subject, verb, and complement. So every sentence can be. So it doesn't have to. So it doesn't have to be like verb, wordy like this. Okay. But the important thing is, so adjectives are usually that frail part. But in here, this adjective has a very crucial role because it is a clue that this company is not going to grow, right? Why? Because if an established company is a mature company, and what is a mature company? Mature company has very little room for growth. Okay, so based on that, this is a case for constant dividend model or zero growth model. So then dividend is constant, $3. And indefinitely, right? So so we know what is going to be a constant dividend, and what we need more is the required return. And says if the required return on this stock is 50%, then dividend over R, right? $3 over 15% comes to $20. So this is this is the intrinsic value or rational price of this stock. Okay. Second example, Lamar Company, a small cosmetics company, paid the following per share dividends, right? Per share dividends, and okay, it looks like this small table is pulled this way. Actually, there was per share dividend, right? Lamar's required return is 15%. So then a small company, once again, company name doesn't matter. We can call it company L. What industry doesn't matter, but small matters. Why? Small firms have a lot of room for growth. Isn't that right? Small. You might wonder how can small company. Small companies are basically currently taking very small market share because they're a small company. They take only like let's say 2% of the market share. That means potentially there is 98% of the market that they can capture. Right? Of course, it's going to be difficult because the big players won't let you, like number one and number two guys in the industry. Big players won't let you survive. They will try to kill you off early on. Right? If you have only 1% of the market share, they wouldn't even bother. But as soon as you start growing from 1 to 5%, they will start to notice, and they will try to kill you off early on. Why? Because everything is limited. The market is limited. It's not indefinite, right? You have limited audience. If you have limited audience, what does that mean? If this company is growing by 1% every year, that means the current market giants, the current market big guys are losing 1% to this company. Market is basically let's say market is very tight, and competition is also very stiff competition, right? What did I say? Stiff competition, right? Under such a circumstance, for any company to gain 1% more market share means that it has to be taken away from other competitors, right? So, so it's not going to be easy for this company to grow, right? Because they will, the big players will try their best to baffle this company. But if they can grow, right? They have, if they are currently taking 1% of the market, then they have 99% of the market, right? Potentially they can grow too. I mean, grow by 99% potentially, right? Anyway, so the adjective, the word small, it has its own function there. It has its own function, right? And then again, you can tell over the last 5 years, or 6 years, they paid. The dividend has been growing, but of course it's been uneven. But we know how to even it out. We take the geometric average, and if we take the geometric average, it comes to something like 6.9 something. Okay, they rounded it, but it is, something like 6 point something percent, 6.9 something. So R minus G, and then this is, next period dividend. How do I know next period dividend is like this? I told you, this is dividend at time t, right? The growth rate of dividend is 6%, 7%. So 1.04 times 1.07 will come to $1.50, right? And then, so we can forecast, dividend at time t plus 1, and then using Golden Growth Model and plugging in these numbers, you come to 18.75. And I would like to show you actually, oh God, it takes too much time. Okay. All right. So let's go to this Excel file. So this is that example, the constant. I think it was this example. No. $2. No, this is not our example. But we it's not a. It's not a big deal. The reason I wanted to show you this model, show you on Excel. So try taking the that. Where did it go? That slide, I can't open it. I can't find it. So I think is hiding here. So the reason I was trying to use Excel was to show you that if you take the geometric average of all this, it comes to something like 0.069 something. So when they round, they just rounded it to 7%. But don't rely on, you have to verify this number, okay? Anyway, it comes to something like that. And then variable growth model is also called, multiple growth stage model or variable growth model. So multi-step model, or the reason for that is I'm gonna skip the product life cycle, but you can tell products go through a life cycle. When it was in the early stage, right? You enjoy monopoly status. I mean, no competitor. You developed a new technology, right? And you have the patent. You are the only one. So you almost enjoy monopoly status. And during that period, your sale goes up exponentially. And then when the competitors figured out, competitors developed their own technology because they figured out, how it's done. And then as the competitors come in, the market goes into growth, right? And then so after that, the maturity stage, I mean, the whole entire industry reaches the maturity. And then after maturity, decline. Of course, not all the products go through this cycle. I mean, eventually it will go through this cycle. But think about it: mobile phone, mobile devices. Where do you think they are? Huh? Mobile devices, mobile phone. They are not even here. I mean, they are close to. I think they are still somewhere here, right? And then not all the industries have to go into decline, because they can reinvent, right? If they reinvent the new purpose of life for a particular product, right? It can be renewed and reused, right?
Professor, I have a question.
Yeah.
Regarding this, is that why you think Apple is constantly coming out with
Yes.
iPhones, like
They,
barely even giving a
yeah,
chance to breathe?
they all have to upgrade. I mean, they always come up with the new upgrades, and the new because if they don't come up with new upgrades, and everyone has a phone, right? And there's no new upgrade, then think about it. The revenue stops there. The revenue doesn't expand. And think about it. I've used my phone for almost how many years? I haven't. If everyone is like me, I think I've had that phone at least for the last 4 years, and it's not the latest model. But everyone is like me. There will be no new sale. If there's no new sale, then no new revenue. Then the company will go into this phase, right? If the sale doesn't increase. So they constantly have to upgrade their model. So think about it. We don't need this plateau, right? When the growth doesn't increase anymore, when the growth is not positive, when the growth rate is 0, when it plateaus out, we don't. That's not when we want to invest in this company. And when it is, in decline, that's not when we want to invest in this company. So we can eliminate these two phases, and at least we can invest in this company in um, uh, during the first stage and during the second stage, right? So here's an example. The most recent annual dividend of Warren Industries, and most recent means this is time zero. Okay, this is time zero. A rapidly growing boat manufacturer. Uh, doesn't matter, name of the company or the boat manufacturer, what industry, doesn't matter. No. But one thing that matters is that, rapidly growing. So that means they are in this stage. It's rapidly growing. They are in this stage, right? And then that means sooner or later they will be into this stage, into this, right? So the financial managers expect that these dividends will increase at a 10% annual rate, right, over the next 3 years. So we have one growth rate, fast growth, right, rate, 10%. At the end of 3 years, so if time zero is 2012, 3 years later, 2015, the firm's mature product line is expected to result in a slowing. Now, this word is also important, like the rapidly growing versus mature. And what does mature mean? When the company is mature, then the sale doesn't grow that much. Very low growth potential, right? Because the market is saturated. So the firm's mature product line is expected to result in a slowing of the dividend growth rate of 5%. So after the first 3 years, then dividend growth rate will steady to 5%, slower growth rate. So now this 5% is basically the growth rate for golden growth model, right? Because now it's going to grow constant rate for the foreseeable future. The firm's required return is 15%. So then we can do it this way. I'm going to where is it? So something's very slow. So here's that example. First, time zero at the end of 2012, dividend was $1.50, and then for the next 3 years, it's going to grow at 10%. So all you need to do is, what I did was basically, this is the principal, right? That times 1 plus D27, which is the growth rate, right? Raised to, of course, years digit is 1, right? Or you can do 2013 minus 2012. In other words, here, instead of 828, you can put a parenthesis. Let me do it this way. Right? You can do it that way too, right? And then drag it down. Oh, no. I didn't lock something. I didn't lock. I think I should lock this one, because B27 2012 shouldn't change. So okay, there you go. So but I have years digit here, right? So either way, that's fine. And then think about it. These dividends are future cash flows, right? Cash flows in the future. So we need to uh, turn them into present value, because valuation is all about what? Valuation of an asset is all about the present value. So finding present value, the same thing, right? You discount it by this once, and then if you drag it down, right, it's going to automatically. And then the sum of all of these present values, that's $4.12. And then after 2015, it goes into steady, constant growth rate of 5%. So that means, we are, this is for using Golden Growth Model. So dividend at time t plus 1, right, can be simply predicted by dividend at time t and 1 plus g times 1 plus g, right? We come to $1. Is it $2.10? $2.10. And then using Golden Growth Model, right? Dividend at time t plus 1 over r minus g, right? Okay, so we find the and this is what? This is the stock price, because you did Golden Growth Model. It's the stock price, but not as of today, not as of 2012, but this is the stock price as of the end of 2015, right? End of 2015 or the beginning of 2016. They both mean the same thing. Then, because our time zero is 2012, we need to bring it back to 2012, right? Bring it back to 2012. So I'll need to discount it by 3 years, right? So that way, we find the present value. So why? This is present value, right? As of 2015, right? The present value as of 2012, right, of the price at the end of 2015, right? Understand? So we need to, then this is the present value, this is the present value, this is the present value of all the dividends for the first 3 years. So we need to add them up. So here, the price of the stock at the end of 2012 is the combination of these two, right? Therefore, it comes out to 1790. So this is the an example of variable growth model. But again, this is a very simplified model, simplified example. If they were to make it very hard, they don't, nicely provide all this to you. They, you'll be given, some raw data, raw information, and from that, like income statement and balance sheet, you extract all this information, and you should be able to arrive at this, right? There's still the the basic concept is still the same thing. It's the application of golden growth model. Okay. So this is an example of free cash flow model, but you might also find similarities between the two, right? Free cash flow model is another application of golden model, but it's a little different in that in free cash flow model we have to introduce a concept of weighted average cost of capital. Okay, that's another thing. Okay, what the heck? Since I already have been. Okay. So what is weighted average cost of capital? You know what cost of capital is. We discussed that concept in topic 1. Interest rate is a kind of cost of capital, right? It's a cost of capital, right? Didn't I tell you? The reason it is called cost of capital is because that's what it costs you if you need to borrow money, right? Let's say you want to borrow $1 million. What is the interest rate? Let's say it's 10%. And think about it. That's, where was I? I think I was, I was digressing, giving you an example. I was. So interest rate is really the cost of capital. And in topic 1 that we defined, cost of capital is another name for interest rate, but it is, cost of debt capital, right? But I told you, cost of capital, there are 2 types, because cost of equity is the required return, right? Because you want someone to invest in your business as partial owner. I mean, if you're buying stock, basically, why do you buy the stock? Because you're looking at rate of return or return on investment, right? You're looking at and if this is return on investment or return on the stock is 20%, in other words, annually, right? And that's, if that is greater than the average return, average market return, and let's say average market return is something like 10%, right? And you are investing in this stock because it gives like a superior return than average. But think about it. This is the cost that the company has to pay to the stockholders to raise that capital. But again, cost of equity is not the company pays directly to the shareholders, right? I've been telling you over and over, they don't pay you anything. I mean, it's only the bond pays you something. The company pays you something every 6 months because it's an obligation, right? Interest is an obligation. However, cost of equity This is something that this is not something that the company pays the investors, but investors can recoup this when they sell the stock. I mean, if the stock price went up 20%, you sell, then you realize, right? You realize that return. So cost of equity is basically, expected return, right? Expected, the mean return, right? And based on this, the investors, oops, what happened? No signal. Okay. My monitor just went out. Suddenly says, power saving mode, and okay, these weird things. So cost of equity and cost of think about it. Cost of capital breaks down into cost of equity and cost of debt, and then the question is, if the cost of debt is 5%, but the cost of equity is 20%, think about it. The cost of equity is 20%. So then, what is the cost of capital? I mean, if it is 20%, right? What is the cost of capital? I mean, what do we use, right? As the discount rate. Hence comes in the weighted average, right? You understand the weighted average. So if they are in equal proportion, right? If it is, the weight of debt is 50%, weight of equity is also 50%, you can just, find simple average. But the weight of, for example, if weight of debt is, weight, this means weight. Weight of debt is, if the weight of debt is 60%, weight of equity is 40%, right? These are returns, right? Then you will have to weight them by their, right? So in this case, this is going to be, so whatever you can, so cost of capital is weighted, that means weighted average cost of capital, weighted average cost of capital. Then in this case, weight of debt times cost of debt plus weight of equity times cost of equity, right? That's weighted average cost of capital. So you need to understand why weighted average cost of capital is important, because why that is needed in free cash flow model, because in free cash flow model, free cash flow is like the, and I've used this example over and over. If you have an apple tree, right? And the apples at harvest, you have a lot of apples on the apple tree. These apples are your EBIT. Of course, from this, you'll have to pay out, you have to pay interest and taxes. And then it will be, EAT, right? But then think about it. You bought this tree, let's say this orchard, entire orchard, and there are like 100 trees, 100 apple trees, and let's say they are, the total value of apple trees are, let's say $10 million, right? It must be golden apples, right? Golden apple trees. And then these $10 million were raised, like 6 million was debt and 4 million was equity, right? So all of these apples, right, when you harvest, it is 60% thanks to debt, right? 40% thanks to equity. Isn't that right? All that, harvest of fruit is, 60% thanks. In other words, this is 60% thanks to debt and 40% thanks to equity. The contribution of equity and debt is in the proportion of 40% and 60%, right? So that's why you need to discount them by weighted average, right? Because free cash flow is not solely, it doesn't belong solely to only the, it's not thanks to only equity, it's thanks to both, debt and equity, right? All right, I guess that, take a look at the free cash flow model later, and then so that brings us to and the definition of free cash flow. Free cash flow is not really, free cash flow is very strictly defined. And then there's an P ratio approach. I'm not, okay. So take a look at that. I think maybe we can come back to P ratio. There's a lot to talk about P ratio because P ratio is its usefulness. I mean, P ratio is not the best or accurate measure, but it is its application or its usefulness is so diverse and it's relatively easy measure of whether the stock is overvalued or undervalued, right? Or its application is so diverse or varied. So I hope I can talk about that, but it's so much time. I mean, what we need to, I guess, it will take the whole hour to talk about P ratio. Then we cannot even go to CAPM. But let's see. See whatever. So I think it's 7:04, 7:05. So I think this is a good time to take a break. So let's take a 10-minute break, and we'll come back and then talk about the CAPM. All right, let's take a 10-minute. All right, we're back. We're back. So now, okay, earbuds. I'm not even putting on my earbuds. Okay. So now we're moving on to the second part of the risk and return. So I'm gonna get where is my okay. This is the second part of risk and return part two starts from here. So okay, so when we say risk, right? Remember in bond, the risk was basically there was interest rate risk, right? Remember in bond there is interest rate risk, reinvestment rate risk, right? What else? And then there was default risk. And where is the default? This is default risk. Financial risk is default risk. And liquidity. The other one is liquidity risk. But in stock, the liquidity risk is not. I mean, liquidity risk can be part of this as well. Business risk. But remember, as in when I talked about when I classified those risks, I said inflation risk and the interest rate risk or the maturity risk are systemic. It comes from the economic system. It's economy wide. Whereas default risk and liquidity risk are firm specific, right? So so the total risk for stocks also breaks down into two categories. One, systematic risk. I mean, it's systemic, originally systemic, but it's called systematic as well because it's more than it's really systematic in it's going to be clear later on. And so systematic risk and unsystematic risk. Unsystematic. So basically systematic comes from basically, economic system. So it's systemic, but the economic system, from the economic system, you have interest rate risk, reinvestment rate risk, inflation. Purchasing power means inflation, right? Because if inflation goes up, purchasing power goes down. Purchasing power risk and exchange rate risk. Exchange rate, it's basically coming from the economic system. And think about it. If the exchange rate changes, and I don't have time to go over this right now, but suppose you are investing in some European stock, and depending on U.S. dollar euro exchange rate, right? If if dollar gets, I'm not going to go into that. This is going to take too much time. So even if you gained, even if you have high return, even if you made big return in that European stock in European market, so you made like 100% return, but when you repatriate it to the U.S., right? Now, if U.S. dollar got stronger, then this is a problem because that 100% return in euro is now very little in U.S. dollars. And when you bring that return back to U.S., then this matters. right? Of course, if that's the case, you'll have to leave it there. But so there's what to a certain extent what exchange rate does when you invest in a foreign currency denominated asset. Foreign currency denominated asset. Now, market risk means stock market, right? What happens to the stock market? I mean, does so they all come from basically come from macroeconomic system, but systematic in the sense that it will be affecting the stock price in a systematic way. Okay, now unsystemic risk means this is not coming from the coming from the systematic sources. One is so they are industry specific, generally industry specific, and firm specific. For example, financial risk means, as I said, this is another way of saying default risk, but not just the default risk. I mean, financial means, leverage. Leverage. You know what leverage is. I don't want to, redefine these things. There are industries that are more prone to be highly leveraged. In other words, there are industries that are more likely to be using more debt. For example, between the restaurant industry and the airlines industry, only restaurant, not hotels and restaurant, but restaurant only. Between the two, airlines and restaurant industry, which one is more likely to be leveraged? I know. What? Okay, just one person at a time. I can't. Which one is more likely to be leveraged?
The restaurant.
Who said restaurant? Who
Jesus.
said restaurant?
Jesus.
Jesus?
Yep.
Okay, and who said the airlines? Who said airlines?
DeAndre.
DeAndre? Okay, DeAndre, you got 0.5. It's airlines, not restaurant. Why? Think about it. Suppose you go to the bank to get a loan, and one is a airline, the other one is restaurant. Which one is more likely to get a loan? Airlines. Why? Because restaurant has not much to offer as collateral. Isn't it right? And restaurant is let's say what is the total asset size of a restaurant? Total asset size at best probably a couple of $1 million, right? But airlines, it would be in the order of billions of dollars at least, right? Because you have to run an airlines company, you have to have a fleet of aircraft. A fleet of aircraft by itself would be billions of dollars, right? A fleet would at least a fleet would consist of dozen aircrafts, like Boeing 747, at least something like that. Boeing 777, Airbus 320. And that's because think about it, a huge fixed cost already. Yeah. Hold on. Yeah. Who? Yeah. Go on. Yeah.
And card as well.
What?
A card.
A car. What do
Yeah.
you mean by car? Automobile industry?
Yeah.
Yeah. Yes, of course. Automobile industry would be highly leveraged. But why? Now think about it. It's huge fixed cost. Huge fixed cost means equipment, plant and equipment, right? Airlines, it's aircraft, so it's not plant, but it's equipment. But then think about it. Uh, so it would take billions of dollars. Borrowing money, you might think the bank will be unwilling to lend because it's huge amount, billions of dollars. Uh, yes, it will be willing to lend. It's not like they are. Why? It's like lending to a property buyer who buys a multi-million-dollar home. Why? Because multi-million-dollar home already becomes a collateral. It's already put up as collateral. Make sense? And on airlines, just like that, on airlines, when they borrow billions of dollars and buy these aircrafts, right? These aircrafts become already, collateral. They are all self-collateralizing. Multi-million-dollar property or aircrafts, they are self-collateralizing. So that means if they default, then the banks can always repossess, right? So sell it off, and then they recover their principal. So they have nothing to lose, right? As long as, of course, the borrower should have a good credit rating. As long as they have good credit rating, they are not likely to default. And in case they default, then they can, repossess. So, but if it is restaurant, at best it would be a couple of $1 million, right? I mean, a small restaurant, owned by the chef himself, a couple of $1 million. But what do they have to put up as collateral? It's not a big amount of loan, but they have very nothing to put up as collateral. And if there's no collateral, then it's not, it has very low chances of getting a loan, right? So because you might think about it, what does restaurant have? The most obvious fixed assets of restaurant is refrigerator, the meat locker, the freezer, and oven. That's just about it, right? And then if it is a multi-million-dollar home, a property, multi-million-dollar residential property, the value doesn't depreciate that much, right? Over time. Actually, sometimes, most of the times, the value goes up. Market value goes up. But meat locker, freezer and oven, how much can you resell it for? So it's not something to, it's not something you can repossess and sell off and recover principal with, right? So think about it. So financial risk means, the higher the leverage, the more likely the more likely they will default, or the default risk is higher, right? It simply means that financial risk means, and it varies by the industry. Whereas business risk is the risk specific to the business, something like in a restaurant, I mean, companies like Apple, the IT industry isn't affected that much by weather or climate, right? Hurricane hits Florida, but IT industries are not hit by that, not affected. But whereas restaurant industry will be affected by hurricane when hurricane hits Florida. Why? If orange harvest, orange trees will be ruined when, right? Oranges will be ruined. Or if there's earthquake in California, orange harvest will be ruined. And when orange harvest is ruined, orange juice prices and industry that affects the restaurant industry. That's an example of business risk. So industry by industries. So and then you can minimize unsystemic risk, but you cannot change systemic risk because how? By constructing a portfolio. If you construct a portfolio with about 20 different industries, with even one share from each industry, right? So if your portfolio consists of like 20 different industries, then the unsystemic risks are almost canceled out, right? But systematic risk cannot be canceled out. So if I show you by graph, see one asset, one asset, risk is this side. But as you add more and more assets, when you have about more than 15 assets in your, and when I say assets, that means stocks from different industries. If it comes from the same industry or similar industries, there's no point in doing that, because it won't diversify the portfolio. Portfolio must be diversified by different industries. If it is not diversified, it's not going to be like drop this. And this 15, that means it's not just number of securities, but it means number of industries, right? Number of different industries. By the time it reaches about 20, then you will have pretty much zero unsystematic risk, and you have only systematic risk left, right? Systematic risk is not diversified away, right? It doesn't go away by diversification, but unsystematic risk gets diversified away. And why? Because of every industry has there's correlation between industries. For example, this is correlation matrix. Apple and Apple. Correlation is always one with itself. Think about it. Your correlation with yourself is always one. Isn't that right? Your correlation with yourself. If you have a identical twin, the correlation will be very high, but it won't be one. Even the identical twin, there's something slightly different, right? And if the more stranger, I mean, even if it is not identical or fraternal twins, but between you and your siblings, the correlation would be, right? Correlation will be high. Between your parents and you, correlation will be high. At least you have 50% of your father and 50% of your mother, right? So Google, look. So you see this diagonal. The diagonal is self-correlation. So diagonal is 1 all the time. But look at first, Apple and Google are IT industries. Look at their correlation. Apple and Google, about 72%. So that's relatively high, right? And then Northrop is defense industry. You probably have heard of they make jet fighters. Northrop, General Dynamics, Grumman. I mean, even from 1920 something, I forgot all these names. Northrop, there's General Dynamics, and I mean, there are many names that only the people who are interested in these, avionics, military avionics, know. And you've never heard of them, because if you're not interested in military aircraft, you've never heard of them. Grumman, Tomcat F-14, that's by Grumman, company named, I don't know if you've watched, I haven't watched, Maverick yet, but when Top Gun came out, 80, that was when 80s, 86. It was Tomcat F-14, and then now it's F-18, and for aircraft carriers, for Navy, but F-35 also for Navy, but F-35 and F-22 for Air Force. But these aircrafts, are made by these companies. Northrop is one of them, right? So defense industry. Raytheon. So look at the correlation between Northrop and Google or Apple. Okay, Apple and Northrop, not very high. Not very high. And then Google and Northrop, pretty much like Apple. And Raytheon is also defense industry. That's a company that makes missiles, and smart bomb. And so look at Northrop and Raytheon. Their correlations are Northrop and Raytheon about 68%, right? Merck Pharmaceutical, Pfizer Pharmaceutical, between pharmaceuticals. So check these, and these yellow highlighted ones are low correlated. Companies that are low correlated, industries that are low correlated. So if when we construct a portfolio with industries that are, especially about 20 industries, then because of this, positive and negative correlations, and some industries have negative correlations. It's hard to find, but and even if you find, it would be like very slight, like negative 0.1 level, but still there are so that's the reason why unsystemic risks are diversified away, because they get canceled out. Mathematically, if I show you mathematically how it is done, this is why. This is, let's say you construct a portfolio with two assets, X and Y, right? And then basically, so it's the variance of the portfolio. The variance of the portfolio is basically, weighted average of the standard deviations of X and Y, right? This is standard deviation of X, standard deviation of Y, and the weight of X, weight of Y. So, and the standard deviation squared is variance, right? And this is something you learned, around 7th grade, 8th grade, and in most common sense countries, most countries where there is common sense, they teach this in middle school, right? And if you say, I've never learned that, because public education system in the U.S., or you just don't remember, or you didn't, you didn't take math because you just, say, who uses math in real life? I don't like math. It makes a big difference. There are people who use math in real life, and they get paid, six-figure salaries, and they are very, protected category because there aren't many who can do that. There aren't many who can do that, right? And if you don't use math, I don't, who uses math in real life? Who used to say, who like to say those things. And what are the choices of jobs that they can have? You can work, like, Walmart, stocking up, merchandise, stocking up inventory. If you don't do math, basically, the jobs are just unprotected. You don't have job security because there are so many people who's like that. But there are very few who can do math. And these people, their jobs are secure because there aren't that many people like that. You can't, easily replace these people. But if you don't do math, you can be easily replaced because anybody can be easily hired as Walmart cashier and easily fired because it can be easily replaced by anybody else. You have to understand that. So if you recall, if you did that, if you recall the expansion rule, x plus y squared is x squared by plus 2xy plus y squared. Now we have weight, so we have to also do the same thing to the weight. And if x and y are random variables correlated with each other, right? Think about stock x and y. Stock x and y can be correlated, right? Like, Raytheon and Northrop, they are closely correlated. Correlation is high. Or Raytheon and Merck or Pfizer. One is defense industry, the other one is pharmaceutical. They may not be, highly correlated. So if they are not, or some may be even negatively correlated. So for random variables, we have to factor in the correlation. So then this rule will be modified to reflect the correlation. This rho, Greek character rho stands for relation, right? Relationship. Correlation between x and y. So, and then rho, correlation coefficient, is basically covariance between x and y over standard deviation of x and standard deviation of y. So at this point, what is that? Never mind at this point, and the correlation coefficient can be between 1 and -1. Think about it. Perfect correlation is 1, right? Perfectly negative correlation, that's perfectly negative. It will be -1. So think about it. If you have, as I said, if you have a twin, identical twin, the correlation will be close to 1, right? 0.9 something. And if you have an identical twin, and if that twin is evil twin, let's say evil twin, then the correlation coefficient will be like, a -1. Why? Because he will be exactly the opposite of you. You raise your right hand, he raises left hand, right? And you drink coffee, he drinks, I don't know, whatever is. There's nothing contrary or opposite to a coffee. You walk right, he walks left. You walk forward, he walks backward. That's perfectly negative correlation, right? Perfectly negative correlation. So suppose we construct a portfolio with X and Y with weight of 50% in both, right? Weight of 50%, weight of X and weight of Y, 50%. And if the standard deviation of X and standard deviation of Y are also 0.5, let's just assume for convenience, and they have perfectly negative correlation, then what's it going to be? Because with the correlation and weight, it's going to be weight of X squared, variance of X, right? This is variance because standard deviation squared is variance. 2 times weight of X, weight of Y, standard deviation of X, standard deviation of Y, and correlation coefficient 2. And then plus, weight of Y squared and variance of Y. You plug in all these numbers. What does it come to? It will come to 0. That means what? The variance of the portfolio will be 0. I mean, under this condition, if they are perfectly negatively correlated, right? Weights are both, 50-50. Standard deviation of both are 0.5. Now, under that circumstances, the variance is 0. What does that mean? If that is the case, it's completely this will be completely 0. I mean, the systematic risk will remain, but unsystematic risk will be completely wiped out. So we can reduce the risk of the portfolio significantly, greatly, right? But in reality, once again, it's almost impossible to find a perfectly negatively correlated stock. Look at this. If the stock is, what is this? What do you think that is? I'll show you, right? You've seen that this is the standard deviation, isn't it right? And the blue stock they both have the same expected return. They both have the same mean. And then a blue stock has smaller standard deviation compared to the red stock. If that's the case, which one is better? You know already. Blue stock is better. Why? Divide, mean variance ratio, return risk ratio. You divide the expected return by the standard deviation. Obviously, blue stock wins out, right? The same mean divided by bigger standard deviation, it will come out as a smaller number. So obviously, in other words, blue stock is like this. The blue stock is like this one, right? The red stock is like this one. Okay. And then, but I think a standard deviation looks like that, but in reality, it's like this. Why? Because this is when those the returns are all happening at the same time, then it's going to be like this. But actually, think about it. These returns happen over time. In other words, this is the mean, and around the mean, this is the right tail, this is the left tail. Because over time, there is a time the stocks have positive returns, and right side of the right side of the distribution above the mean. There are times, and then there are times when stocks are having distributed to the left side, right? So a low risk stock has less volatility, whereas high risk stock has more volatility like this, right? Over time. And then think about it. So we may not find, so if we plotted a long timeline, stock A, this is stock A, right? And if we find a stock that is perfectly negatively correlated to stock A, it will have to look like this. Stock B will be perfectly negatively correlated. But if we have stock A and stock B perfectly negatively correlated, they cancel out each other. Think about it. When the stock A has very good return, we have exactly opposite return from stock B. So they cancel out. On stock A, so it will always be, right? You will always have expected return. But in reality, as I've been telling you, it's hard to find something like that. In reality, it's more like this. It is slightly positive. It's positively correlated, right? In a way, it's not negatively correlated. More, but even when you find a stock like A and C, then if you combine those two, the portfolio return will have much lower volatility. In other words, that way, that much volatility or the risk is reduced by constructing a portfolio, right, with two assets, two securities. If two securities can reduce the portfolio risk by this much, how much more with more securities in the portfolio, right? With all different, coming from different industries. So, and I already, identified I ran the correlation. That was, already a long time ago. I used the data between, 2006 through 2011. That includes, obviously, the periods between and after, before and after financial crisis. This one is after financial crisis. But you can see these are low correlations. Now, so then, okay, I understand by diversifying the portfolio with a lot of industries, especially if they are negatively correlated or lowly correlated, then we have a good chance of getting rid of or diversifying away the unsystemic return. But what about the systematic return? Well, the systematic return will have to be taken care of by correlation with the market. So remember, the correlation coefficient between random variables was rho, but the correlation with the market is called beta. Why correlation with the market? Now think about it. The market is a big force. Think about it. A single stock cannot pull up the market when the entire market is going down. Right? Isn't that right? If the entire market is going down, by the way, how was the market today? I didn't even have time to check the market, but let me quickly. Now think about it. If you are during the bad, during even during the recession, right? There are companies that do well, right? That is called, counter-cyclical stock. That means that stock has negative correlation with the market, right? Usually, pharmaceuticals and defense industries are relatively insulated from the market. In other words, when the economy is good, generally if the economy is good, all of the companies are doing well, generally, right? But so when the economy is good, generally all companies are doing well. But when there are some companies that are not doing well when economy is good. On the other hand, vice versa, when the economy is bad, these companies are doing well. Why? Because they are negatively correlated. It means they are negatively correlated with the market. And so it wasn't very good today, right? But there are some, Asian markets and European markets, US market, wow. NASDAQ 2.55, this is bad. But even so I'm so wait a minute, come on. So some usually pharmaceuticals are not very much not positive, highly positively correlated with the market, because even during the bad economy, the medical spending continues, right? Medical, and almost everything lost. I'm heavily, I'm heavily into the NASDAQ, and NASDAQ is, okay, and also defense industry is, generally considered to be low correlated. So where was I? In general, so think about it. Unless you want to have something, you want to have in your portfolio, you want to have something that has negative correlation with the market, right? That way, when the overall market is going down, your portfolio, most of your assets in your stocks in your portfolio is also going down. But that the magnitude of descent will be mitigated if you have something that is negatively correlated with the market, right? Also, think of it this way. The correlation with the market, if the correlation with the market is 1, what does that mean? If market goes up by 1%, your portfolio also goes up, or stock goes up by 1%, right? But if so beta, which is the correlation coefficient, and the correlation coefficient rho and beta are basically two of the same kind. One, first of all, in case of rho, which is the correlation coefficient between different industries that we wanted to diversify away. they are all independent variables, right? X and Y are independent variables. In other words, Y's movement, Y's change doesn't depend on X, right? Vice versa. So they can go either way. They can run, the correlation can run either way. But in beta is the correlation coefficient, but correlation runs only one way, from X to Y. Why? Because, as I told you, X is the market, Y is the individual stock, and market is a big force that cannot be affected by a single stock. But a single stock is easily affected by the market. Think about it. When the market is generally all, going down, just because you have a stock that is going up, that one stock cannot pull up the market, right? Because market, is, there are 500 stocks in S&P 500, 500 stocks, right? When one stock does well, but the remaining 499 stocks don't do well, right? That one stock cannot pull up S&P 500, right? For S&P 500 to be pulled up, at least more than 50% of the stocks in S&P 500 should show positive trend, right? Don't you think? So beta is, in beta, the correlation runs from market to individual stock. Market is X, individual stock is Y. So think about it. This is a typical example of correlation coefficient of 1. And that, in other words, beta is 1. That means when beta, in this case, I'm sorry, in this case, beta is 3.5. What does that mean? When X moves by 1, beta moves up by, Y moves by 3.5. So when X is 1, beta is 3.5. X is 2, beta is 7. If X is 5, Y should be 16.5, right? And, and all those coordinates, all those plots will fall neatly on a straight line. Why? Because this example was artificial. In other words, you already determined beta value, and you simply, in X, when you X will automatically generate Y according to this beta, which is the correlation between the two. And the correlation is nothing but, the slope, right? Slope. So look, when beta is 3, 10.5, beta is 5, X is 5, 17.5, and so on. But this is not the reality, because, in this example, they gave you beta value already, and this is what you did probably, in middle school, right? Like 7th grade, 6th grade, or 7th grade, you learned this linear function, and so everything, the plots fall neatly on the straight line because it was already predetermined. But the reality is not like that. The reality of the correlation between X and Y is more like this, right? It's a scatter plot. In other words, this is the plot of, these are the coordinates of, X and Y. When X was this, Y was this. When X was this, Y was this. when X was this, Y was this. And so in other words, it's all scattered, scatter plot. And when I say X, I'm talking about this X-axis. And Y, I'm talking about Y-axis. You might wonder, why that's X and this is M? Listen, I told you, M stands for market return, right? YK, remember cost of capital. It's the market cost of capital. It means, cost of the market. In other words, that's market return. Market should give at least this cost of capital. X is any stock X. So it could be Apple, it could be Google, it could be anything, right? But the correlation between, it captures the correlation between the market return and the individual stock return. So based on this, what you can do is you will need to find the slope of the best fitting line, because you don't have a, think about it, these coordinates, the plots don't fall neatly on a single line, on a straight line. They are all scattered. So the best you can do is find a slope, right, of the straight line that best fits this scatter plot. And the best fitting line, you might wonder, oh, this is the best fitting line because it's in the middle. I mean, the candidates can be something like this, something like this, or something like this, something like this. Among all of those, it's in the middle. So that must be the one. No, not because it's in the middle, but because this has the least squared errors. Right? This line will, if this is the best fitting line, it's because it gives the least squared error, right? So if you find beta that way, and mathematically we find beta, covariance between X and Y over variance of X. Remember, rho, in case of rho, is covariance of X and Y over standard deviation of X and standard deviation of Y. But anyway, so beta measures, correlation between the market and the individual stock, and that means if beta is 3, what does that mean? When market goes up by 1%, the stock goes up by 3%. So you might think, oh, the higher the better, higher the beta value, the better it is. No, not necessarily. Why? But that means if market goes down by 1%, what does that mean? The stock goes down by 3%, right? So higher beta means higher volatility. It's not necessarily a good thing. And then based on that, they developed, CAPM, or capital asset pricing model. And capital asset pricing model is, we're out of time, so I cannot really, you should have studied this because everything was posted already, pre-released, right? And you should have already studied this. And I've been telling you over and over, collaborate session is not the main lecture, right? The pre-released videos are the main lecture. It's like this, CAPM basically makes adjustment to the, what does the CAPM do? It doesn't really price any asset directly. It's just an equation. It's an equation to find the risk-adjusted discount rate. Risk-adjusted required return. Okay, it's the risk-adjusted. It's the way to find. It's the model to find risk-adjusted required return. Okay, the concept is like this. If beta is 3, what does that mean? It's 3 times more risky than the market, or 3 times more volatile than the market. If the stock is 3 times more riskier than the market, then the stock's return should be 3 times 3 times the market's return. Does that make sense? If beta is 3 times the market stock return must be 3 times the market's return. Why? That's the required return. Why? Because this is 3 times more risky. That much must be it must be compensated by the return that is 3 times the market risk. Okay. All right. So that's all the time we have. So you have, tonight you have the final left. So good luck with the final, and that wraps up everything about Finance 100. So have a great evening, and good luck with your final, and have a great rest of the summer. Actually, 3 days later, fall semester starts. All right, that's it. That's it for tonight. Take care, everyone. I already said, good luck with the final. And
Thank you, Professor.
good luck. All right. Good night. All right. So I'll stop.
Thank you,
recording.
Professor.
All
Good
right.
night.
Take care, everyone. All right. Thank you. All right.
Thank you,
Take care.
Professor. Did you